Well, thank you very much, Fred. Good afternoon, ladies and gentlemen. Today, I am wearing my gray suit, gray shirt, somber gray tie, black shoes, and black socks, my usual uniform for funerals and memorial services. And the occasion today is the funeral of the Great Recession of 2008, 2009. The recession is over and a global recovery is underway. Indeed, Fred is even more optimistic than I am because he speaks not of a turning point, but of an inflection point. The inflection point is where you go from slower to faster, or the other way around, so I assume Fred is expecting not only we're having a recovery, but it is indeed accelerating at this moment.
I know what you're going to say.
Well, I'm going to try something here, but it didn't seem to move anything. Don't know what its problem is. Oh, down. Wow. Very good. Okay. So what I want to do today is review the global forecast, which I try and keep to a reasonably limited number of numbers, even though there are a lot in this table. Talk about the prospects for the U.S. economy in more detail, and then reflect a little bit on what many other people have put forward as the sources of pessimism about a reasonably rapid-paced recovery. Let me say that I have downgraded a little bit my forecast for both global and U.S. economic growth during 2008. That's partly in the U.S., mainly in the U.S. It's the benchmark revisions to GDP estimates, which were released in July. For other countries, the first quarter of this year turned out to be more of a downward movement than I had anticipated it would be in April. The main story, however, is that I have upgraded for both advanced countries and developing countries the growth forecast for next year. The ruling principle for these forecasts is what I have previously referred to as the Zarnowitz rule. Victor Zarnowitz, distinguished economist who studied business cycles throughout his career, observed that as a virtually invariable regularity, deep recessions are followed by steep recoveries. Now, in April, there was still some residual doubt as to whether we were in fact going to see the bottoming of the recession around the middle of this year, which was underlying my forecast. I think the evidence is now clear for the United States and for the world economy that in terms of GDP, we hit bottom around the middle of the year and we have begun the upturn. And so I think we now may expect that the Zarnowitz principle, the Zarnowitz rule, will in fact control us going forward. That being said, while my forecast is taking account of that rule and is in fact substantially more optimistic than the average of external forecasts, and I'll return to that, the theme at the end of this presentation, I am not assuming that we're going to get quite as rapid a bounce back as we normally do following such deep recessions in the United States and a number of other countries. So what I'm anticipating for global growth next year on a year-over-year basis is now 4.2%, whereas it was previously 3.7%. For the advanced economies, I'm anticipating 3.3% growth year over year, whereas previously it was 2.7% or 2.8%. And for the developing countries, the forecast has been advanced a little more than a percentage point to 5.4%. Now, normally, global growth has been running around 4% on average. We had about a 5-year period in which it was running close to 5%, but that was clearly above potential, as subsequent events have shown. So the recovery is approximately, for the global economy, to the rate of growth of potential on a year-over-year basis. For the advanced economies, where the recession has been significantly deeper, the recovery is to a growth rate that is somewhat above potential. a half a percentage point at least, probably about a percentage point above potential. As I said, I'll talk about the United States in more detail in just a couple of minutes. Let me comment on what I think is happening in the rest of the world. First, well, Nick will talk about China and the strong recovery that is clearly underway there. India is a very similar story, and China is very important to the rest of Asia, and we've already seen some spectacular rebounds in Asian emerging market countries in the second quarter, where they've been reporting annualized growth rates of GDP in the 10 to 20% range for about half a dozen of the larger economies, excluding China and India. I don't think things will keep going at that pace, but with China continuing to expand, emerging Asia should continue to recover as well. That recovery in Asia will benefit Japan. Japan was very hard hit in its export sector, and as a consequence of the very sharp decline in exports, domestic investment also dropped sharply. We have seen exports begin to rebound in Japan, and I expect that investment will follow within a quarter or two. Nevertheless, since the potential growth rate in Japan is quite low at this stage, less than 1.5%, I'm not expecting extremely buoyant growth on a year-over-year basis next year, but a substantial recovery from this year. I might note also that I've reproduced in this table the forecast which the IMF released in early July, and you can see that my forecasts, particularly for next year, are well above theirs. We'll see when the WEO comes out in September. My guess is that their forecast will be revised up a fair bit, but will still be below mine, particularly for the advanced countries, probably much closer on the developing market countries. The euro area suffered a very sharp decline in output, both the last quarter of last year and the first quarter of this year. France and Germany turned in, it is estimated, very slightly positive growth in the second quarter. Other countries, the rate of decline slowed, but they were slightly negative, so the euro area on average was very close to zero, slight decline in the second quarter. There, too, I expect the Zarnowitz principle will rule, but I'm expecting less of a rebound in growth in Europe than in the United States, partly because, at least the data I've had a chance to look at so far, indicate that inventory investment in Europe has gone less negative than in the United States, and so we're not going to get as powerful a kickback from inventory investment there as here. Also, the potential growth rate in Europe is, I think, at least half a percentage point below that in the United States. The story differs among European countries. Germany is a very heavily manufacturing economy and very heavily export-oriented. That was the part of the economy that was hit during the global recession. It's turning around now on the basis of recovery of exports, and I expect that all of Germany's principal export markets, and Germany is a very diversified exporter, will show substantial recovery over the year ahead, and that will drive the German economy forward. Investment was also hit in Germany, and I expect it will recover as exports recover. The story is not quite as sunny in the United Kingdom, where the financial sector is very important, and the economic difficulties in and spreading from the financial sector are probably going to weigh on growth a bit more going forward. Nevertheless, I am expecting that we'll see a meaningful recovery in 2010. In the emerging market and developing countries, I've already mentioned Asia. In Latin America, they have fared less well in the global recession than Asia or most other regions, largely because Mexico has been hit very hard by the present global recession with its strong links to the United States. Mexico will suffer about a 6% GDP decline this year, and I'm expecting them to recover to have 3% growth year over year next year, helped very considerably by the recovery which will project for the United States. Brazil, in contrast to Mexico, has fared the global recession quite well, and I think GDP growth this year will be very close to zero, maybe slightly positive, maybe slightly negative, and it will accelerate next year as the global recovery takes hold. Central and Eastern Europe and the former Soviet Union, the CIS, a number of countries, especially the Baltics and the Ukraine, have suffered very, very deep recessions. And other countries have suffered recessions of significant depth, though not in the more than 10% year-over-year decline range. I expect we'll see quite significant rebounds in these countries beginning by the second half of this year. And in contrast to the prolonged recessions we saw in the early to mid-1990s, where a complete restructuring of the economic and social systems of those countries was required, this time I think we'll see more of a classic business cycle rebound. And that will be even more apparent, I think, when we move to 2011, which I'm not prepared to forecast on a detailed basis now. The Middle East has survived the recession, worldwide recession, quite well, as has Africa, despite very large declines in commodity prices. And I expect that growth will be up again next year to the 4% range. So that's the broad overview of how I see the global economy advancing. I should mention that I think inflation at the global level will remain reasonably well subdued. Commodity prices have already risen a fair bit from the lows that they set late last year and early this year, and I think we'll get some more action on commodity prices. But we have very considerable slack now in global supply of many key commodities, including oil. So I'm not expecting those prices to go back up near their peaks of last year, at least not before the end of 2010. Well, turning from the world economy to the U.S. economy, it always tends to be the case at the bottom of a recession and the beginning of an expansion, particularly if it's been a deep recession, that the mood is very pessimistic. And most people just can't see where the expansion is going to come from. It does come, but they just can't see where it's going to come from. So I thought it was useful to look at my scenario for where I think the U.S. economy will between the middle of this year and the end of next year, so a 6-quarter period, where the U.S. economy will produce GDP growth of almost 7% cumulatively. So an annual rate of about 4.5% cumulatively, 7% growth. Now let me note that if we go back to the relatively deep recessions of the 50s through the 80s, not the shallow recession of 1990-91 or what is now the non-recession of 2001, because the revised figures show GDP didn't decline during the recession of 2001. But if we go back to the deeper recessions, there the average recovery of GDP during the first 6 quarters of the expansion cumulatively was 10%. I'm projecting just below 7%. So I'm 2/3 of the normal recovery. Now, there are reasons not to be quite as buoyant in the forecast going forward. Potential growth is a little slower, and there are a number of things which are likely to keep this recovery a little slower than what we've seen in the past. But what I've put on the table here is not an enormously enthusiastic forecast for growth. I mention in this context that in the fabulous Reagan economic recovery, the first 6 quarters, GDP grew almost 12% cumulatively, and domestic demand expanded 14% from the trough in the 4th quarter of 1982 to the middle of 1984. And I'm only barely half the pace of the Reagan recovery. So where is the recovery likely to come from? Well, I do have a gain in consumption, but the thing to note here is that the gain in consumption is proportionately smaller than the rise in GDP. So I'm expecting GDP to go up almost 7%, I'm expecting consumption to expand in real terms about 5%. The savings rate is going up from around 5% in the second quarter of this year to about 7% in this scenario. Now, it could go up somewhat more, it could go up somewhat less, but I'm not assuming this is going to be a consumption-driven recovery. Consumption is going to get pulled along as GDP rises. But households will be raising their savings rates in this scenario. So if we're going to get a substantial recovery, a lot of impetus has to come from elsewhere. Part of the elsewhere is government spending. Now here I assume that even with the stimulus package, because of the pressure on the budgets of state and local governments, that the cumulative rise of government spending over this 6-quarter period will only be 4% in real terms. So the stimulus is working against other factors that are tending to keep government spending from rising very rapidly. The main impetus for recovery is coming from private investment. First and foremost, inventory investment. Inventory investment was running minus $159 billion at an annual rate in the second quarter of this year. Businesses are going to want to take it back at least to zero. They're going to want to stop decreasing their inventories. And I think probably we'll want to have modestly positive inventory investment by the time we get to the end of next year. So I've penciled in a $180 billion gain from inventory investment. Business investment in equipment and software has been cut 22% since the start of the recession, a quite large decline by past standards. And in net terms, that is taking account of depreciation, business investment in equipment and software is probably now slightly negative. I am anticipating that half only of the decline we have seen since the start of the recession will be regained by the end of next year. Now, business investment in non-residential structures. There, the peak tends to come late, much later than the peak in general activity, and the trough tends to come well after the recession is over. And there I'm assuming that that component of investment is going to continue to go down through the middle of next year and not have much recovery before the end of next year. So I put in minus $50 billion for that component of investment. Residential investment is down as of the second quarter, $440 billion from its peak at the end of 2005. We already see evidence that it's beginning to turn, and I anticipate that as the economy generally recovers, we will get back 1/3 of what we lost during the downturn. We'll get back more later, but by the end of next year, 1/3 or $150 billion. So if you add all those things together and make the allowance for the rise in consumption, the projection is that domestic demand in the U.S. economy would rise a little less than $1 trillion. GDP will rise somewhat less because I anticipate that as the U.S. economy recovers somewhat more rapidly than other industrial countries, that our net export balance will deteriorate. But it will not deteriorate as much as in, say, the Reagan expansion, where the U.S. growth of domestic demand enormously outpaced everybody else, including many developing countries which were falling into the debt crisis of the early 1980s. So the deterioration in our real net exports will subtract only $90 billion, and that leaves us with the $875 billion total figure, which is 6.8% increase in GDP from the level in the second quarter. Now, one can push that number up 1 or 2%. One can push it down 1 or 2% by plausible adjustments in the various components of GDP. The Blue Chip forecast survey just released in early September. There, the average among forecasters is that the gain in GDP between the second quarter of this year and the end of next year would be $426 billion in real dollars, or 3.3%. I think that that's just too pessimistic as a central forecast. Inventory investment will come back. We will get something from the stimulus package. Business investment should have at least a modest recovery, and consumption will have some growth if the rest of GDP is enjoying some growth. So a central forecast of only 3.3% growth over 6 quarters just seems to me to be too low to be plausible in present circumstances. I don't insist that 6.8% is the exact number. Could be 8%, could be 5%. There's a lot of uncertainty, but I think we should at this stage be anticipating at least a moderately vigorous recovery. The story, as I say, varies from country to country, but I think the same type of analysis suggests that we should see a rebound in the rest of the world. And moreover, on this occasion, unlike previous global recessions in the early 80s, in the mid-70s, and in the early 90s, we're all in phase. We all went down together and we're mutually reinforcing on the way down. We are now all coming up together, and I think we will be mutually reinforcing on the way up. A couple of other issues, and I don't want to go through the document has a lot of discussion of these things. A couple of other issues. Many people point to continued problems in the financial sector, both in the U.S. and the rest of the world, as likely to be a very important drag on recovery. I go into an extensive discussion of this issue, and what I say is, while there is some truth in it, it is vastly overdone. The general rule has been that you need to achieve some degree of stability in the financial sector, so it's not falling through the floor. But once reasonable stability is accomplished, then a strong rebound can occur. Now, in this context, many people point to the Great Depression as an example where the financial sector suffered enormous damage, and it took us 7 years for the total to get back to where we started. Well, that's quite true. But what happened in the Great Depression was that from the middle of 1929 to the middle of 1933, real GDP fell about 30%. If we had quarterly data, that's what we'd see. And over the next 3 years, from the middle of 33 to the middle of 36, real GDP regained all that it had lost. So it was the quintessence of the Zarnowitz principle. Deep recession, very steep recovery. And while the financial situation was stabilized after the bank holiday of March of 1933 with the introduction of deposit insurance and the rest of it, one could not say that the U.S. financial system was in robust good health in the summer of 1933 or any time soon thereafter. The dominant rule then and in other deep recessions is that it is the recovery of the economy which fixes the banking system. It is not that fixing the banking system produces the recovery of the economy. And I think that that's what we'll see this time, not only in the U.S., but also around the world. The double dip. And there is a lot of discussion of the prospects for a double dip recession, that those people who were speaking 6 months ago about the fears, 9 months ago about the fears of another depression, well, that seems somehow to have faded. And the L-shaped cycle has also faded a bit. And so what people say is, well, we're going to get an up, but then we're going to go down again. Just no way to turn it off. Well, we've had one double dip in U.S. history, post-war history, and that was the 1980 recession, which was very sharp, was followed within 9 months by another recession in 1981-82. The reason for that was that the Fed slammed on the brakes and the Carter administration put in credit controls in early 1980, pushed the economy into recession. They backed off. The inflation rate initially came down, but then it popped back up to double digits by the end of 1980, and the Fed had to do it again and push the economy into another deep and prolonged recession. That will not happen this time. Inflation is very low. In fact, it's negative on a 12-month basis if we use the overall CPI. More importantly, core inflation has been falling and is likely to continue to fall. At some point, the Federal Reserve will want to wind back all of the stimulus that it's put into the system, but it's going to be careful about doing that. The only thing which would occasion the Federal Reserve and I think other central banks to tighten suddenly and sharply is if they actually saw evidence that underlying inflation was picking up. And I don't think we're going to see such evidence, at least not before the middle or end of next year. So I just don't see the scenario in which policy is going to suddenly tighten and produce another recession within a year and a half or 2 years. I think sudden massive tightening of fiscal policy is even less likely. So I just don't see that the scenario of a double-dip recession for the U.S. or elsewhere really makes much sense. Now, that does not say that if a 50-mile wide asteroid suddenly struck the Earth, it would not wipe out all life as we know it. That is to say, other shocks could occur, but there seems no reason to forecast them at this stage. So I think we are launched on the path of recovery, and we should carry forward with that through at least the end of next year, and I would bet for a considerable period of time beyond that. Now, finally, I wanted to reflect on how forecasters have typically viewed recoveries. And so what I did was I went back to extract from the record what the forecasters were saying at roughly this stage in the recession recovery cycle of the early 1980s. So late 1982, early 1983. The administration released its forecast in February, but it was locked in sometime around the middle of December. And the administration, old rosy scenario, they were forecasting fourth quarter to fourth quarter growth in 1983 of 3.1%. The Federal Reserve staff in the Green Book, about the same time, they were forecasting 3.1%. Now, the administration didn't revise its forecast until the mid-session review in July. But the Fed staff produces revised forecasts every 6 to 8 weeks for each FOMC meeting. And you can see that the forecasts of GDP growth gradually pick up as we move through the winter and into the spring of 1983. However, everybody substantially undershot the actual outcome, which was 6.3% growth, as measured at the time in 1972 dollars. Subsequent revisions to GDP estimates have pushed that number up even a little higher. The year-over-year numbers forecasts are also reported there, and the same pattern shows up. For the unemployment rate, I think it is really very interesting. The administration was forecasting that the unemployment rate, which was 10.7% for civilian workers in the fourth quarter of 84, they were projecting to decline to only 10.4%, so 0.3 of a percentage point decline. The Federal Reserve staff in December was expecting the unemployment rate to go nowhere in 1983. And as we move through the series of forecasts, you can see that even by May, they were expecting that the unemployment rate, as of the fourth quarter of 1984, not the year average, as of the fourth quarter, would be 9.7%. The actual outcome was it was down to 8.4%. So we had nearly a 2.5 percentage point drop in the unemployment rate over that four-quarter period. I emphasize that I'm not anticipating this year quite so buoyant a recovery, either in the first year or the first 6 quarters or the first 2 years. But the pattern has been that essentially all forecasters tend to underpredict the recovery, even once it becomes clear that a recovery is underway. And I think that that's what we're seeing this time, and what we'll see over the course of the next months is that forecasts will be gradually revised up as data increasingly shows that the recovery is well established and underway.